Good evening, good evening, good evening. Let me just see everyone's logging in. Looks like we're getting some people jumping in. We will get started pretty quickly. Market chugging up slowly. Thanksgiving week. A lot of Americans have probably got the week off, so I think the volatility will continue to be low. But hey, we've seen more surprising things in our time. Let some people join. Thank you for joining me this evening, by the way. Wherever you are, 6 o'clock UK time. Some of you guys have been in Europe. Appreciate you logging on for this. I hope to make it worth, and will make it worth your while. This is going to be a series of webinars, actually. Another series going over the next couple of months with Pepperstone. And I really want to dig into the intraday chart as I could say, probably a little better than that, but how the trading strategies need to be or should be deployed a little bit differently depending on the day type we've got. So we're going to talk about the open today, and then the next webinar I'm going to talk a little bit more about finding those swing points kind of in the middle of the day, so those kind of high spikes that we get, those noon balloons, that kind of VWAP extensions, those trend type days. And then we're going to move on to the close, looking at some of the closing strategies to potentially deploy some of the kind of panic closes, VWAP magnet type stuff. So the idea is over the next kind of series, we're going to run through the day in intricate detail and kind of focus on some of the things that perhaps to look at in a little bit more depth. We're going to be very tactical. We're going to spend about 45 minutes covering this webinar. If you want to stick your questions in, you can do. I think you'll find the button somewhere or there. Everyone's reasonably tech savvy here, right? There's a questions section, pump them in there, and I'll get to them at the end of the slides. Let me just maximize that questions area. Cool, okay, I think they're coming through, great. So many of you guys know me already, but a very, very quick intro if you don't. My name is Mark Holstead. I've been trading since 2001, 2002, 2003, started to do things seriously and more full time. Long time ago now, how crazy. YouTube, you can see my YouTube, UK spread betting. I kind of started to do that just to keep myself from meddling with trades. And people seem to like some of the videos, so great, it's good. It's a win-win situation. I can talk about trading, which I can talk about for radio because I love the markets, I love trading, I love getting involved in trading, I love talking about it, I love sharing ideas and doing stuff. I also have a podcast, Traders Mastermind, if you want to check that out. All right, so disclaimer, read that while it's up on the screen, guys. And also something to mention is, and just from a kind of pure operational perspective, I'm going to share some things with you which are strategies, setups, ideas, but you absolutely should, and regardless of where you're hearing it from, you should kind of use it as a seed to go out and kind of do your own research and have a look for yourself and just say, hey, that sounds interesting. Can I dig into it myself a little bit more? Can I find some more information about it? Because that's when you really have the edge and ability to hold trades. Because I think that we can get ideas and stuff, but then when it comes down to it, we need to believe and have the confidence to hold that trade to fruition to make the strategy effective. And it might even work for you. You might find that, hey, some of this stuff is too active, it's too aggressive, or whatever it may be. So this is really, an information entertainment webinar, if you like, for you to go away, maybe write some notes and say, hey, I quite like that, I'm going to investigate it further. This is not a kind of turnkey thing. And there's no such thing out there, guys. It's about getting inspiration, getting nuggets and ideas. All right, so let's get started. Okay, so Day Trading Club series, Scalping the Open. As always, if you've been here before, I like to have a stoic quote, and this one's from Epictetus. We should always be asking ourselves, is this something that is or is not in my control? And I like to pick a quote that is relevant to trading, very, very relevant to trading. We can control the risk, we can control some things, but once we've got the trade on, we can't control where the market goes, right? And so at that point, we've got to be like Epictetus and say, it's not in our control. I've got my stop loss in, I've got my target in, or I've got my management area, or however you kind of going to adjust and conduct the trade, and that's it. And what happens, happens. And we have to be at peace with that. All right, so let's get started. Topics for today: trading the indices open. Now, when I talk about open, I really talk about the kind of the US session or the European session open. We'll talk more about that in a moment. But risks and challenges with trading the open. Obviously, it's an active time. It can be risky. Configuring the charts, going to have a quick idea of how to set out the charts or how I like to have them set up, and you can perhaps model that. Opening types and categorization, super important to use the right tool for the right conditions, and we'll talk about that. Pre-open filter process, re-look at some of those ideas that we've talked about before. And then I've got 4 kind of strategies, if you like, to dig into. And we've only got 4 to 5 minutes today, so I'm going to kind of gloss over them, give some rules and structures to me, some examples, and then you can go into more depth. And if you like that, you can kind of go and do some extra research. But it's giving you the seed of the idea. So momentum ignition identification, a 2-way open and strategy to go with that, scalping the 1-minute moves, and flush identification and strategy. And we'll kind of work out how we configure those within the right conditions. And again, I do want to reiterate that this is information, right? This is do your own research, and not again, not into the fact that, oh, should I use this or not? It's like, because you want to get the confidence yourself, and you don't get that unless you've done the research yourself and then you believe in the trade. Because if the trade is going away, starts to pull back, if you're just doing it because you think you should do it, you're going to cut the trade. Whereas the guy who's confident in the trade is going to say, listen, it's doing exactly what it should do, hold it, there's no need to panic on this. All right, so I just want to define the open before we move on. We define the open here as GMT, 8 a.m. DAX, or the FTSE if you're trading those instruments. That's the German 40, UK 100 if you're kind of navigate those on Pepperstone, CFD, or the spread bet product. 2:30 p.m. is the US Open from UK, and that's Dow, S&P, NASDAQ, any of those things. Maybe you can trade Russell, and those are US 30, US 500, NAS 100 accordingly. And you can trade them the Asian Open as well. I just don't have, I have very limited experience trading the Hang Seng or Nikkei or ASIC, but I assume they're kind of the same type of thing. So if you're on that neck of the woods, then you can treat that as the open. It's basically anytime there's a bell goes and the stock exchange, the underlying exchange, actually starts trading. So even though we're trading index and a lot of these trades 24 hours a day, it's when the actual stocks, the underlying, starts getting rolling. Okay. Scalping and open risks. Listen, the open can be lucrative, but it's also with high risk. Why? Because it's a time when you can, if you're not careful, start to trade on tilt, because the market can be whipping up, whipping down. It's rallying. You're kind of chasing it. You're getting caught out. It can be a very risky time. So if a discipline is still a work in progress, stay clear of the open. Like I remember, many years ago, what have we now, 2050, 17 years ago, let's say 18 years ago, I saw everyone trading the open. So I'll trade the open, but my discipline was still weak. I was still breaking rules. I was still making these errors, and it made it worse because it just magnified my weaknesses in trading, my lack of discipline. So just be careful if you're still trying to nail down the discipline, then I'd advise you to stay clear of the open, at least in a live account anyway. Demo, fine, get you feel for it and stuff like that. Work on your longer term holds and stick into your rules. And some traders do very well not even trading the open. So it's not a prerequisite, right? Just be careful you're trading on tilt. Just be careful when you kind of loss stacking. In other words, you're losing this, losing that. And I've got that phrase from a trader called Paul. He talks about loss stacking. But it's this kind of, I'll get stopped, and get frustrated. And also just remember, scalping's fine and being active's fine, but understand that your edge does diminish the more active you are, because you are paying a commission. Even if you're paying razor thin spreads, and even if you such a really liquid instrument with tight spread, you're still paying to trade. So if you're really active, that is a cost that you've got to account for. Excuse me. So just be aware of that. Okay. Let's talk about optimal chart setup. And I'm going to use TradingView as an example. I know most of you probably use TradingView. You can trade, you can route your orders through to Pepperstone through TradingView, and obviously it's a great charting platform. And by the way, I think they've got some good deals on now for the premium version. You don't need that, but anyway, it's by the by. I'm not promoting TradingView here. I think it's just a useful and good charting platform to use. So I like to look at 3 different kind of main windows, if you like, alongside my tick index window. And I think it was the last webinar I did where I talked about the tick index, and it's super valuable. Interestingly, it was, it's something that's not covered much, but it's super valuable on one chart window I have up. So that included in these. So single market view overnight, we'll look at example in a moment. Single market view, regular trading hours, which RTH stands for. So that's when the bell goes. And then quad market view, for the major indices. So set your time frame. I'm not a big stickler for time frame, but like, what's the best time frame? What's the best time frame? To me, it's a time frame you can fit most of the useful price data onto your screen. So if you need kind of 5 days of data, then you're probably going to have, obviously, depending on the width of your screen, you might have to have a 5-minute chart so you can see that. If you want to see 3 days, you might go best go to a 3-minute chart. If we've gapped up massively and it doesn't even matter what happened yesterday, then you probably need a 1-minute chart, right? So you want to put the data in that you're interested in and put it on the screen. Okay, so as an example, a 24-hour chart, nice and clean, nothing on there. I've just got a 24-hour Dow index chart there showing multiple days. And so I can just see what's happened overnight. I can see the just general structure. And we'll talk about how we separate overnight and regular trading hours in a moment, but I always want to see the main structure. And I think that it's important to be able to see that, important to be able to see what's happened and remind yourself, because we get so zoomed in to the prior 2 days or 3 days, we forget that it was a spike 4 days ago, whatever it may be. So I think that's very, very important to have that. And then the regular trading hours chart. So this happens to be one I use the tick index on as well. I'm not going to go into tick index again today. I did last time, and the recording is available for that if you want to check that out. But what I do here is I use the futures contract on TradingView, and this allows you, just for charting purposes, you can still trade obviously your CFD or spread bet product through another window, or if you're going directly into Pepperstone broker, you can still do that. But just using this, the reason I use this is just so I can see the gaps more clearly, because this will only start printing at, for me, it's 2:30 UK time, and stop printing at the end of the day, kind of 9:50. I think it kind of pushes on for the futures. If you're trading the S&P 500, you can use the ES, or you can use something like the ETFs like SPY or Q. And we're not trading these actual products, of course, but it allows me to see the gaps. And I like to see the gaps because I'm just calibrated that way. I just like to be able to see how prices responded to the gap. And obviously, you don't get that with a 24-hour chart. So, and at the moment, unless someone might be able to come up with a fix for this, but if you're kind of charting the US 30, by default, it's going to show you everything. And so you want to look at another product that gives you just that regular trading hour session. It helps with the VWAP as well. So that's worth doing. Okay. And then the other screen, if you've got another screen, if you've got one screen, you can still flick between the tabs. I'm looking at 4 markets. So I'm kind of looking at the Dow, I'm looking at the NASDAQ, I'm looking at the S&P 500, and I've got one more market on. And that normally for me, that changes. You know, sometimes I might have the DAX on there, sometimes I might have gold on there, had yen on there a while ago when USD JPY was just ripping. You have something that you feel is the engine of the market. You guys might want on the yields, whatever it may be. But I don't necessarily make a decision from this, but it helps me kind of see which is the leader, which is the lagger. So I kind of have them calibrated about the same scale, and I can see and I can go, you know, when let's say the Dow's breaking to lows, but NASDAQ's not quite, S&P's not quite, I might either go, oh, you know, do I want to just wait until the S&P cracks that low before I jump on the Dow, or I might adjust my decision making to suit. Now, I don't want to make this overcomplicated, but I like just to see, to see who the leader is in the pack. Who the leader is and who the laggard is. So I think that's important to have as well, especially if we're trading the open. Okay, so gauging the open type before the bell. As a reminder, 3 months ago, 4 or 5, I can't remember when it was, the webinar, we talked about this. And as part of the webinar, I gave you guys a free PDF checklist. It's still available now, I think it is, tradesmastermind.com/pre-market-checklist. Could have made that easier, couldn't I? But the checklist in there, just as a reminder, this is so important. We're trying to calibrate ourselves to the correct open, because if we don't get that right, we end up getting on the wrong side of the open, and we're not always going to get on the right side, of course, but we want to give ourselves the best possible chance. So we look at, just a reminder, not going to cover old ground too much. We're looking at the daily chart, super important, the overnight range, the gap expectations, the open position in the range, either the overnight range, or we open at the high, at the low of the range, the middle of the range. And you know, why I kind of bang this drum so much, and why I'm just absolutely adamant every day. I'm just looking and checking, gauging what's going on, because I know that over time you get better at judging the open type before the open, and then as the open starts, you start to then reinforce that idea or negate the idea. So if you say, hey, we've had a big overnight range, the daily chart looks like it's breaking out of the flag to the high side, we're gapping up, we're opening at the high of the overnight range, you might be prepared for a big momentum drive. We'll talk about some of the ideas for that in a moment. But if it starts to sit and stagnate at the open, you go, oh, hang on a second, let's not get giddy here. Let's just maybe once a little dip first to attempt to fill the gap, and it's going to be a kind of two-way rotational open before it breaks out. And so you start to, if you hadn't done your pre-market prep, and if you hadn't done all this kind of stuff, you wouldn't have any idea of how to kind of trade it. So honestly, it's super important to do this. It's super important to look at that daily chart and look at and you get better at it. You just improve over time. You know, as an example, the other day, you know, the market has actually resolved to the upside at the moment, or Dow has by the look of it. But we've had this situation sometimes where the market just sits in kind of tight ranges, right? The other day we had it rallied hard and it was sitting in a four-day range. And I've highlighted these on here, times when, you know, price has just done nothing. And then you go, okay, well, should I really expect an aggressive momentum move? Should I really be positioning, buying at highs, looking for fresh highs? You start to note things down. You start to get an idea of how you want to position before the open, because if we're going to scalp the open, going to trade the open, we want to make sure we're trying to align with at least the idea of expansion or contraction or two-way trade or whatever it may be. And so it's one of the most simple things. It's super valuable. Get your daily up. You're all adequate and more competent technical analysts, let's say, because I know you guys are, you know, reasonably experienced, because you come on this webinar and you kind of understand technicals, you understand you know, how to kind of look at a chart and get a good idea of what's going to happen. But so be able to look at the daily chart and saying, look, we're in a range. Unless we break out that range, then I probably need to be careful. Versus, well, we've had a big, massive, heavy day to the downside. Looks like we're going to follow through. That's a different expectation, right? So just don't underestimate the power of the daily. Okay, so trade or no trade. I can't stress enough that the default setting should be no trade. And this goes without saying, whether we're trading open, whether we're trading swing trading, whatever we're trading. If we go into the market by saying, hey, I am not going to deploy my capital unless I see something I really want to take risk on, that's completely opposite from the beginner trader who looks for a trade and tries to find a trade, and they will always find a trade. You put a beginner in front of the screen, you put a more experienced trader in front of the screen. The difference is, I guarantee you, the beginner trader will find a trade no matter what the conditions. The more experienced trader will only take a trade if the conditions are right for them and the trade is setting up. Think about that. It's worth thinking about. How often do we go in and try to find the best trade on the day, when in reality, there's probably no trade on? So have your filter set for when you even consider getting to a trade or not, i.e., hey, I want to have a big overnight range, I want to have this daily chart, etc. So even though we're scalping and we're getting into the weeds, if you like, on the intraday chart or 1 minute chart, whatever it may be, I'll talk about 15-second chart in a moment, you still want to be doing it in the right conditions, because a choppy open is just brutal. It will just rip your face clean off, and you'll be like, oh man, why did I even get involved in it? So have a filter and be very strict with that, and then map out your ideas. You know, say, hey, what am I looking for? How do I expect the market to do? Is it going to drive? Is it going to do this? Check your daily chart again. Check your overnight action again. Go through that process. If it's chopping around, if in doubt, stay out. Let the dust settle. There's nothing worse for your psychology than to get caught up trading the open. You almost hit your daily loss limit, and you're like, man, the market's done nothing. I've bought high, I've sold low, I've got chopped up, and I've got no bullets left to trade the rest of the day. And it's frustrating. That's when you can end up breaking rules, trading until. So if in doubt, stay out, let the dust settle. There'll always be a good trade opportunity, you know, if you give yourself time. And it's easy to get seduced by volatility. So again, that's a structured trade idea. Steer clear. Honestly, it's so important, this, and it's something that just, you know, let's go off track slightly. You know that the one thing that damages you the most are losing trades. And so we have to have both eyes focused on those losers and say, hey, how do I minimize those losers? I want to make sure those are minimized. I want to make sure they're minimized. How do I do that? And so, yes, we're trying to make winning trades. Of course we are, but we've got the eye on those. We're not going to let those get out of hand. So we need to work out a plan of attack, right? If we decide that we want to get involved and we think there is a supply-demand imbalance, which is what we're trading, we want to work out a plan of attack. So here's an example, one I did the other day. When I put these slides together a couple of days ago, and listen, this is, you know, it's not pretty. and you guys are not going to be able to read this because my handwriting is pretty poor, but I can read it. I know what's going on. And I'm mapping out some of the ideas for the open. And I'm saying, hey, what am I going to do? Expecting, how am I going to get short? How am I going to get long? What I think is going to happen? What different ideas I've got, little comments, little things. And I just start to build, really rough ideas, literally on a notepad. And whatever it is for you, can be more structured, can be more serious, can be typing, whatever. But it's calibrating your mind into saying, hey, what am I actually looking for? What am I trying to do based on, again, going through the previous kind of checklist we've got. Okay, so we've got a few choices of the open type. We've got, and this is where it gets, this is the tactical stuff now, the operational stuff. So if you switched off before, time to tune in now, because this is stuff that's going to interest you. Volatility expansion, breakout, momentum ignition. So that's kind of moves, extensions, if you like, spring, stretch, keep stretching, or it's kind of inside out type trade. We're looking for further moves, looking for breakouts, looking for kind of extensions, that type of stuff, looking for momentum. We've got the fake and fade type open, which is the one that kind of just gaps down, or also not gaps, it drives in one direction and very quickly reverses, catches a lot of people out and just rips in one direction after that initial fake. We've got a kind of scalp the tape rhythm. This is going to talk about this 1 minute strategy for this. It's kind of ping-ponging back and forth, up and down, and we're kind of just rotating, waiting for it to resolve. And the market profile guys would probably categorize it as this: opening drive, opening test drive, open rejection reverse, and opening auction, or open auction, should I say. An open drive, I've confused everybody here with this, but one open drive would be your volatility expansion, open test drive would be your fake and fade, open rejection reverse would be fake and fade because it's a slightly longer duration. Not that this matters too much. We'll give some examples in a moment. An open auction is when it's kind of just going back and forth, up and down, and it's rotating. And our job, again, let's go back to the initial thought on this. When you're about to trade the open, you don't want to be sliding in your boxer shorts going, right, ding, market's going, let me go long. You don't want to do that. You want to be prepared and have an idea of what the open type is going to be. You want to be like, okay, I think the odds are we have this open type, and you start to put in a category and go, I think we're looking for maybe a volatility expansion because of the daily chart, because of the overnight range, because of this and this. Okay, how would I want to play that? That could be this, it could be this. That's far more prepared than going in going, well, I'll see what happens, shrugging your shoulders and getting sucked in to just some things because the candle suddenly spikes. You go, we're ripping. You buy the high, comes back, stops you out, and you just get frustrated. So have that structure and start to put things in a little bit of a categorization in the box. A few chart examples here. I just pulled off recent moves. There's an opening drive example. By the way, the open, for me, it's the first 15 minutes or so. Some people say it's until the first rotation. Some people say it's the first 30 minutes. Some people say, for me, 15 minutes. Now, there's no definite thing. If you go in a textbook, it's not like a definitive definition for it. But for me, it's about the first 15 minutes. So what it does in the first 15 minutes or so is probably really considered to be the open. Let me get into 5, but it's that kind of order of magnitude in terms of time frame. I'm not talking about 2 hours, right? Opening drive, gaps up, just rip straight away. You can see that that's just driven 200 points in however many minutes that is. That's an obvious opening drive trade. Open test drive, this isn't the best example, the best one I could get for the past few days. And again, I hate cherry picking too much. It's like, okay, fine, but I hate kind of looking, you go all the way back to June and go, I got one, okay, fine, but real world, open test drives when it kind of pulses in one direction first and then pushes back. Admittedly, it's very, very short, and you could argue this is an opening drive without the test drive, but the idea is it pushes the other direction first. I've got some other examples, better ones in a moment. An open auction is just when it's back and forth. And one thing I like to call this, guys, is dirty candles. And look, you can just see what I mean by that. It's just a grubby red, green, red, green, red, red. There's nothing really going on. There's tails, there's wicks, there's indecision. There's no real supply-demand imbalance. We're below the VWAP, above the VWAP. We're testing lows, we're testing highs. It's just a rubbish, horrible, low-range, choppy bleh. Now, we can, if we really want to, I'm going to talk about a drill and a way to maybe take advantage of this, but, generally you're better off going, what, it's a rubbish open, it's an open auction, it's just chopping back and forth. Let me do some work on my strategy. Let me do some journaling work. Let me kind of look at some chart. Let me do some other homework to move your trading business forward rather than getting involved in this nonsense. And you can see the difference, right? If you go back to the open test drive, clean, good. Okay, yes, there's obviously some red, green in there, but much more clean structure. You have to be an amazing technician to look and see the difference in the chart. So when you start to see that, you're like, okay, oh, easy. If I'm going to deploy capital, I'm going to be very, very careful about how much I'm deploying here. Versus, hey, this might be a grade A setup. Let me kind of push a few more chips into the pot here. So there's your open auction type. Then your open rejection reverse, which is when it probes in one direction and pulls back. And you can see here we kind of went to the downside, we pushed back up, back to the VWAP, went to fresh highs, and then before the 15 minutes was up, we come back and we're pretty much where we were at the opening print. So this is kind of this open rejection reverse type maneuver where it's clean, some structure, there's some decent range. That's moved a fair chunk compared to this nonsense, but it's very tradable, absolutely, and we'll talk about it in a moment. But it's two-way. It's two-way rotation. Okay, so let's get down to some more operational things. So momentum ignition identification. This is your opening drive play, and in a perfect world, we want to be able to identify momentum as it's igniting. Okay, we want to really be as early as we possibly can to that momentum, because we can then ride that momentum, and then when it starts to come to a crescendo, we can be the type of trader who maybe peels some off, especially if we're looking for a scalp. Also looking for a multi-day move or a whole day move, very different. You might want to add to this position then. From a scalper's perspective, the earlier we can identify the momentum, the better, right? So again, go back to the clues. Large overnight range, that's a chance there's going to be some momentum. There's a bit of supply-demand imbalance. That's a window into what the traders are doing. There's not much liquidity overnight, even if the S&P or the Dow, whatever it may be. And if they're kind of executing and getting these large ranges, this could be like that. There could be business being done right at the opening bell. A breakout, a daily pattern, just like we said, if it's kind of resolving to the upside on a flag or bouncing off or whatever it may be, that could be a good opening range, opening drive play. An opening near to the high or low of the overnight range. So we have the clues. We go, okay, we could be a bit of momentum ignition type trade. Let me get ready to position for that. Then we're looking for clues at the open. The big persistent drive in one direction, urgent move, all indices in sync. Bang. Okay, let's get rolling. So how do we get involved in this trade, or ideas to get involved in this trade? It's not how to, it's more kind of, let's think of some ideas. And we're trading with a tight stop on this. We're scalping, tight stop. It's a momentum play. It has to go straight away. If it starts to reverse, then get the hell out of there. You know, and it's fine because it's momentum. You've already categorized it as momentum. You should be very aggressive with the way that you cut the losers on this. So we join the move. Small pullbacks, little pauses, little flags, single candles. Try an example in a moment. Wait for, okay, this is not a bad one actually. If you're a Dow trader, this is at the moment, this is reasonable. So you wait for a pause or a pullback of about 20-30 ticks, and again, that's, you know, average that out for your volatility of the conditions you're in and calibrate for the move you're trading. But that's about right. And so the market kind of comes up, pulls back about 20-30 ticks. Often then it kind of starts to go, you see it rolling back, sets kind of green then red, 20-30 ticks pullback, starts to come back up. By the time you kind of see it, maybe it's 5, 6, 7, 8, 10 ticks, boom, there's your trigger. Buy when price stalls, or wait for a break above the high of the first red candle for a long drive. Let me show you that one because that one's quite nice. So here's an opening drive. Got 1 minute chart on the left-hand side, 15-second for your hardcore on the right-hand side. Now, if you're a scalper, you kind of want to go down the time frames, right? And again, let's go back to the first slide of scalping is not the be all and end all. But if you're trying to jump on momentum, get out quick, get your cash, get out of there, then you probably do want to go down the lower time frames. So imagine this kind of chart, it's kind of pushing to highs. If we go to that setup idea, which is, hey, we're buying the first break of the first red candle, the break of the high of the first red candle. So as soon as we see that red candle, we're like, okay, fine, it's rallied. Now, perfect world, we're on it from the open. But this is the thing, a real world, guys, unless we take a little bit of a guess on that and go, hey, the overnight structure looks like it could rally, I'm going to take a bid from the open, then we're not going to be on from the open in print. And I'm always cautious about doing that. And I don't like to do that myself because very often we get that whip the other direction before it goes your way. And we talk about two-way open where you kind of long, you think, yeah, this is just going to be a big bullish day. We're going to close at highs. I'm going to get long. You get long at the opening print. It just, the rug gets pulled. you have to come out because it's such a big move, and then it goes from whip straight back up again. So we're trying to avoid that. We're trying to see the structure first. So, you know, if you were trading on a 15-second, that first move actually on the 15-second, you'd want more than that. You'd want to see more structure than that. But it's an example. As the first red candle, you see it, and then you're buying and a break above it first. And really kind of, it's probably more like this, because if you look at this area here, your first red candle is, if you're trading on a 1 minute, is here. So you're buying kind of as it comes above that high there. It's a very simple, very binary way to trade it. And the stop's going to be below that low. And if you go on a 15-second, you see that rally, and you're already, and again, this is why it's so important to be ready and prepared for this. As it starts to rally, you're like, okay, I'm not going to wait. I'm going to wait for I'm not going to join it. I'm going to wait for the first red candle. Then when that forms, then subsequently as you break a high, I'm going to get involved in it. And that's just one way of you know, making a very, very simple execution model. Because some of the things that the challenge with the open is, we say we want to get on board momentum. We often don't have a very good way of doing it. We end up chasing at highs, we end up doing this and doing that. Whereas if you've got this way, you say, okay, there's structure, there's momentum, there's the pullback, and then there's a trigger to get in it. Now, if you want to nuance it even more, then that'd be my guess, but that's just one kind of idea to think about with that. Here's another one. And the 1 minute chart, sometimes you don't get the red candle until very, very late. And obviously, if you were here on here, you're going to get stopped. And of course, you're going to get stopped on some trades. You are going to get stopped on some trades. But that's when, if you're aggressive scalper, you go down to your 15-second, you go, right, big drive, where's my first red candle? There it is, I'm buying above my first red candle. And in reality, again, if you're super aggressive, fine, but you could get caught in a whip out there. I'd like to see, you know, a good kind of move starting to go. Let's see it starting to go, start to go. And so these are kind of big drives off the open, kind of translate into this 15-second chart. So this type of break up here, you know, is a nice, simple binary way to get into the trade. Would you like to, is it be better to get down here? Of course it would. And if you can read the tape and read that little turning point, then even better. But a structured way, and why it's structured and why I like it, is it's a very simple and clean and obvious place for a stop. The challenge we have when we're trying to buy these dips is, where the heck do we put the stop? Now, it's fine if you have a fixed stop, but that catches so many traders out. They look to buy the dip, it keeps going, like, and the deer in headlights. Before you know it, 30 seconds have gone, we're right back down to the open, and you're down way more than you want to. At least this way, you can kind of put a real easy structures to trade. You go, okay, first red, after I've seen a couple of minutes of drive or a minute of drive, fine, break the high, stop goes below the low. It's a very simple, and I'm going to scale it out into highs, and or maybe whatever exit criteria, look at exits in a moment. But it just eliminates any doubt. Is it the best way of doing it? Probably not. But does it create structure to the trade where you've got an obvious stop point? Absolutely, it does. Downside as well, you know, we get this kind of gap here. I should put some more maybe context to this, but it's a big move lower, gapping straight off the open, rally. First green, we're selling below that first green. And we can just see that's an easy structured way to get into a trade from the short side. Okay, low. Let's talk about, so that's the opening drive type trade. And we're looking for momentum, first red, and then a break above. And it's tight, it's straight. You know, you've got to be quick off the ball, you've got to be very, very keen and good at execution. But you can get on some big moves. And the good thing is, you know, even if you get stopped out, the R multiple that you can potentially get, you know, it is pretty good. So the second type of open we've got is the two-way open type. I'll call it the boomerang open. So this is when it pushes in one direction, fails to follow through, reverses back the other way. And often it's better to align with the overnight trend. So if the trend is up and we're gapping up, it's a push lower, but then reverses. And there's this kind of, you know, some ideas of patterns that we'll see. And we'll look at some charts in a moment. I like this, because I find this easier to really get on, and I feel that it's an easier read, and you feel like you've got a bit of a head start. And the people who are trapped and getting stopped up there adds a bit of fuel to the fire. It's just a nice place to be as a trader. So here's the larger context of this play. You know, big overnight range, opening at highs, trend is up. The prior close I've marked on here, if you can see that on your screen. So we're gapping up, overnight range is good, tick, 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 tick. Here we go. We get the flush lower that comes back to that prior support. And actually, there's a cluster. I think I've got another chart in here. Yes, but let's go back to this first. There's a cluster of kind of lows. then it takes off. So let's look at that a little bit more. And again, we're aligning ourselves with the trend by waiting for that flush first. So let's have a look at how we could get on board that. Here we go. So this is zoomed into that part. Pushes down to the overnight support, catches a bid that fails. And yes, you'd probably buy that and get stopped on the first go. You know, that's life, real world trading. It's not perfect. Right? You probably see that. You want to be positioned long. You're waiting for that. You see the flush off the open. You see that little pin bar, and you go, but I'm in. It's broken above that first red candle. Oof, I'm off. And you might get stopped out. Fine. But then you go, okay, I'm still going to use the same systematic trigger idea, which is I'm going to buy above the first green bar high or the last green bar high. Again, super simple. But it's like what we're trying to do, all the legwork's done beforehand. We're doing all that work by deciding how we're going to trade this before, and now we're just going to kind of keep things simple. And yeah, advanced traders can kind of bit more nuanced, but that's the way to play it. We break above the high here, then you're probably going to get stopped out as you come down here. So you're waiting, you're like, I'm going to buy above this high, no, this high, no, this high, yes, off we go, we're in. And he stops there, and what happens? We get straight back up. And your stop is always going to be below that trigger bar, or the signal bar if you like. And then if you're a scalper, you're probably going to come out quickly and scale some out into the VWAP. You're probably definitely going to come out some into the open. And then if you're kind of maturing into a day trace where you get these multiples of risk, you might just say, okay, I'm going to trail this up and see where it goes. And perfect world, it goes higher. Sometimes it's going to come up to the high, retest, and come back lower. And it might turn into those two-way auction opens. But you're still aligned with the trend. You're still trying to just look for one specific thing. You're not getting yourself caught up and kind of you're tied up in doing stuff and going long and short and getting stopped. So, and actually, I put this in here because this was one of the ideas I had before this actual open, and that kind of little a journal entry shot I had in a couple of slides ago had different ideas, and one of them was exactly this, which was, okay, we're in a position long, and you can see how very similar it is to actually how we developed. But that's not me going, oh, I've got a crystal ball. That's me going, okay, this is one of the ideas. And when you start to see the trade open align with one of your ideas, you become far more aggressive and far more committed to the trade that you take, and far more determined to take the risk and be happy with the risk and not let the trade go early, because you're like, hey, this is one of the ideas. I'm not going to waste it. So summary is that two-way open, catches a bid that fails. Admittedly, that'd probably stop you out. The second bid finally rallies, overdoes that loss by many, many multiples if you're getting a good move on that. Systematic trigger ideas, again, we're keeping it simple. We're buying above that last bar high. We're waiting for it to commit first. And some people are going to say, hey, I like to get in earlier, that's fine. But that's a very systematic way of doing it, again, because we can structure the stop below that trigger bar. All right. Scalping 1 minute moves. Now, let's just caveat here. This is for the very aggressive trader. And I would suggest that this is as good as the price action drill. So I mean that if you struggle to take losses quickly, if you want to encourage quick decisions, then this is a good drill. I think this has limited edge because you're trading very, very frequently. But it's good to kind of, yeah, again, get yourself used to trading quick, get yourself used to being aggressive with your execution, not necessarily with your size. That's a recipe for disaster if you're not prepared and ready, but just be able to cut stuff quickly, bang, bang, bang. So we're basically going to identify the opening drive open type. So beforehand, like, okay, I'm expecting an opening drive, I'm expecting this, I'm expecting that. Join the momentum. But the difference is with this scalping 1 minute move drill is that we just hold for 60 seconds. So this is quite freeing, right? Why is it freeing? Because we go in and we say, hey, I'm not trying to hit home run here. I'm not trying to pick the high. I'm not trying to pick the low. My job today is to identify momentum. I think is going to continue for at least 1 minute more and jump on. And this is a really freeing exercise. Like I say, be very careful with this, with size, and obviously manage your risk and blah, blah, blah. All of that stuff that comes with it. But it's a very good drill for you to look for momentum, because this can then expand into, hey, where's that higher target? But this job is very, very blinkered. It's like, hey, I'm on this market. All I've got to do is identify where I think I'm going to get momentum that carries on for another 60 seconds. That's really freeing. That's really freeing and liberating from a perspective of being able to just operate as a discretionary, aggressive scalper. It's very, very freeing. And it's a good drill because you 60 seconds, there's no more rules to it. And yes, there's open-ended risk here. Excuse me, you could get hammered. Of course you could, because it's a timed thing. You could just suddenly get on a trade and just suddenly wipes the floor and comes out. So you've got to appreciate and accept your risk and put other things in. But it's a very good kind of thing to do to encourage you to make quick decisions. 60 seconds up, ding, bell goes off, whatever it is, poof, I'm out. Whether it's a stop, whether it's a loss, or it's a gain. And it just conditions you to be able to trade quickly. And you can make that 30 seconds if you prefer. I prefer the momentum type thing. If you want to, if you're like a mean reversion type trader, then you can identify choppy open and fade those 1 minute moves. So if you instead of looking for momentum, you flip the script and you go, hey, where do I think price is going to turn? And it's going to turn for 60 seconds. I think it's a lot harder. And I'd say that's do the momentum one first. But if you're absolutely adamant about doing mean reversion, that's one way to look. Okay, so let's stick on that for a moment. How long got for time? Okay, we're good. Left hand side, this is kind of market you want to fade, right? To me, this like you see 1 good minute of drive and then it's just chopping around. Admittedly, it's reasonable, but if you see that in the first kind of few minutes, you might want to go, hey, listen, it's not followed through. I'm expecting momentum. I see momentum. It doesn't continue. We don't get a break of that first red. You know what? Well, early on we don't. Kind of just chopping around. We get these dirty candles, dirty candle alert. That's probably something you're definitely not going to kind of be looking to follow, and maybe look to fade, or even better, just don't trade that nonsense. Versus look at the difference in this, which is the same chart we had before. It's a much more obvious supply demand shift. Just use your intuition a little bit. I know there's a lot of controversy about intuition and this and that, the other, but just trust your gut. You've been trading a while. You know the difference between these two charts. They're massively different. You know the one on the left is one that just is the nemesis of traders. And there's going to be traders that go, oh, no, there's a structured double top there and this, that. That's fine. You know, if that's your thing, then be my guest. You know, I never, ever say to anyone, don't do something if it's working for them. But if it's not working for you, consider not trading that and saying, listen, this is stuff I like to see. I like to see momentum. I like to see the obvious pause. I can buy above the high. I can be more structured. I can be more clean. And you might say, yeah, but it's hindsight. But it's not at that point in time, because you go, right, that's very similar. But then look, after that, dirty candles, not much going on for a long period of time versus a continuation. That's when things start to change, when things look a little bit better. And that's why using a very structured trigger entry, potentially, like above that first red, keeps you out of this nonsense, because you're not involved. You're like, okay, 1, 2, 3, all these bars. By the time it does go, do you really want it? Maybe you do, but I don't. It's momentum play. Like I said before, momentum play's got to go. You want it now. And this is when you can be very precise and very aggressive about what you want. But this breaks that thing. It does go. Yes, it loiters a little bit, but you're getting some momentum, you're getting some move, and finally it's breaking through. Very different characteristics. So always be calibrating yourself to the characteristics. Excuse me. So let's talk about this 2-period. Sure, a glass of water with me, should I really? Never mind. 2-period rate of change. So this is, I'm not a huge fan of this, but I wanted to show you because I know some of you guys like to dig into the indicators, like to use a more structured approach. And one thing you can do is this kind of triple flip, if you like, and a rate of change. And it's a 2-period rate of change. And the reason I like it is because it's very short term, obviously, but you're kind of watching for a trend move. Let's see, trending up, the rate of change flips down, which is your pullback. And then when it flips back up, there's your entry to buy with a stop below the low. So in this case, again, I wanted to include it just to kind of something to investigate further. Trend from the open, got the gap, everything's looking good. Trend starts to come lower. So this is one basically if you didn't want to buy above the high. So if you didn't want to kind of buy this high here, or the first candle high, however you want to structure it, you thought that was late, you could use this. Rate of change flips lower. Then the first time it flips higher after flipping lower, after you pull back, then there's your buy signal, and that'd be on that candle there. So you wait for the candle to close. Same again with this, kind of same type of thing. The rally, your rate of change just flips lower slightly. And the first flip up, there's your buy. So it's just a slightly different way of making a more mechanical, a systematic way to get on this, because the nemesis, and listen, you know, what we're trying to develop as traders is much more of an intuitive flow and discretionary way to trade. We're not saying that we're going to trade this way all the time, but this is an idea to kind of get you looking at some of the triggers and some of the more mechanical ways to get into the trade. Look at your charts, see how that would work in the real world, and say, okay, how can I refine it? How can I be better at that? How can I kind of get the entry earlier? Or how can I be more aggressive in my size? How can I minimize the risk? And it's just kind of digging in and investigating, especially the open, which is much very lucrative, potentially lucrative place to trade. All right, so final thing, the flush identification. So we haven't really had one of these for a while, and I wasn't going to include it. But I thought, I'm going to include it because just going at it for a while, that I won't include it, and then we'll have loads of them. So we often get this flush after a large gap, and it's often the last gasp from the prevailing trend before it's exhausted. And as scalpers, and this is, guys, if you're a scalper, you know how nice these flushes can be, because if you're on the ball, it's kind of, you take the trade, bang, instantly you're up 50 ticks, 30 ticks, whatever it may be, and you're in a nice position. You go, do I hold it? Do I cover it? Do I move on? And if you're prepared for the flush, then you can just look for the trigger signs. And listen, most of the time you're not going to get it. Most of the time the conditions aren't right. But if it is right, then it's I think it's a high probability trade, in my opinion. So your trigger signs for your flush is your large extended move in one direction. We'll look at example in a moment. Over a very, very short period of time, an immediate bounce off the low rather than a stall. And then we're looking to go in. And it's 3 waves. It's 3 wave things, very, very important. We want 1 wave of selling if it's from downside. Second wave, the third wave is when we see that final extreme followed by the large green candle. So we see the extension, pause, extension, normally deeper pullback, final extension, just like a vomit of price, bang, last big move. And then we're not going to try and be clever. We're going to wait for the first green candle after that. So here's an example here. Open there, drive lower. That's 1, not very aggressive. 2, starts to pick up steam, pauses. 3, there's your third leg, and then there's your first large green candle. So let's dissect that a little bit more. Extended down move, already very stretched. Another wave of panic selling, very, very large last few bars panicking. We're not getting in front of it. Don't step in front of a train. Do not step in front of a train. It will run you over. You wait, you wait, you wait, you wait, you look. You've got time. What time in the world? You say phase 1, fine. Phase 2, fine. Now, in the perfect world, you want to be shorting this, but let's say you're already aligned with the flush. You're already in your mind, I'm not going to sell this. I'm waiting for the flush. I feel that's the better trade. Then you do that. Again, it's about waiting for the trade that's valid for you rather than getting caught in every little thing. You wait for the first phase. The second leg starts to pick up steam. And the third. Now, this example, we don't have many pullbacks in this. And those of you who are on Trading Plan Pro who have access to that tool, I've uploaded these in the strategy section templates with more screenshots, and they're kind of deeper pullback. So 1, drive lower, pulls back. 2, deeper pullback. But there's generally three phases to the flush, and that's important, because then you just sit and wait. You're like, hey, there's no rush. There's no rush. I'm just going to wait for that third leg. Okay, from the third leg, I wait for that last big move, and now we wait for us a green candle. And again, why are we doing that? We're doing that because we can structure and put the trade under the lows, just the stop under the lows, sorry. Whereas when we're buying in the flush, and we've all made this mistake, guys, we try and buy lows, it goes lower and lower and lower. Worst case scenario is you're adding to stuff. Oh my God, that's like sacrilege. You're like, and then you're stuck in a trade. You're going, God, I'll never add again. I'll never add again. I'll never add again. I promise. Let me out. Let me out. Let me out. You forget about that. It's beginner stuff. You're more experienced in that now. You can wait to say, listen, let everyone do this. Let them be the fuel to the fire that is the last vomit of stops. I'll wait. I'll wait for that. We're in phase 3. I'll wait. You go, the lower you go, the better that bounce is going to be. You sit there, you wait, and then finally you get that last big range green candle. It's the biggest range green candle you've had all morning. There's your trigger. Now, is it always going to work? Of course it's not. That's why we have a stop in, but it's a good place to structure it. And the problem is that most people think, that's way off the lows. That's like 75 points, 100 points off the low. Man, that's way too low, or way too high. Look at the magnitude of the move. And this one went back from 32,300 right down to 31,650. Huge move. So look at it in context. And again, you're just sitting, waiting. You're waiting, you're patient, you're like a sniper, and waiting for that green. That green's got to come. It's got to be a big green, and it's got to be after phase 3. I've got nothing to do before then. I'm doing absolutely nothing before that. I'm not trying to be clever. And if I miss it, I miss it. If it doesn't give me this flush, it doesn't give me the flush. But at least you know and you're prepared for it. And it's such a good place to be when you've been prepared, you're waiting, and you're not panicking. You're not feeling like you need to get in. Okay, I'm just going to wait. I'm just going to wait. All right, summary, and then I'll go look at some of the questions, guys, if you've got any. Want to try and get as many clues as possible to the open type before the bell. I think that's the biggest thing. If you can be positioned and start to jot out in your mind, like I do on this notepad, what's the day type going to expect? And what am I kind of out of position for? What would I do this when I get long, when I get short? Am I expecting a drive? Am I expecting two-way? Am I this? Just think about it, and you get better at it over time. It might be first time you do it, like I'm rubbish, I'm no good. But over time, you start to get better. You start to feel more confident in the way you're structuring your trades. Then want to quickly judge the open type the first few minutes after the bell. So, hey, are we right? Is it a drive? Is it reversal? Is it choppy? And sticking to that. So if you come into the day and think, hey, you know what, it's going to be a choppy open, and there's a choppy open, then wait and go, okay, I'm not going to trade it. I'm not looking to my 1 minute trade drill. All I'm doing now is looking to maybe see if it kind of develops into a trend or develops into something more. And then that comes into what we're going to cover in the next webinar is, hey, where do I get involved in? Where's the areas to do business that I might want to look for reversal back to the VWAP or the midpoint or a further extension, that type of thing. And once we've categorized the open type, which you will get better at over time, we then deploy the correct strategy for that open. Are we chasing the trade with a momentum ignition type trade, waiting for that first red in the break? Are we waiting for kind of a dip lower and then a continuation? How are we playing it? And again, a very simple rule of thumb. You'll be like, well, how do I know if it's a dip lower or a complete reversal? A very simple rule of thumb is, again, be very structured and strict and say, hey, I'm only going to trade with a trend. And that means if it gaps up and just drives lower, it's gone without you. You're not interested. You're only looking for long and it doesn't trigger long. But if it gaps up, pushes lower, finds support, you're ready for the long. I think the issue we have many times with traders is we flip-flop back and forth between is it long, is it short, is it long, is it short? And sometimes you might say, hey, I'm going to wait for the long, I'm going to wait for the long. It's gapped up, I think I'm going to dip and I'm going to rip, and then it's going to be great, I'm going to add to this. And it just keeps going lower and lower and lower and fills the gap, and fine. That happens. But that's a much better place to be, is saying, hey, I misjudged it, I misread it, I made nothing, I lost money. I made money, I lost nothing, should I say, rather than I got caught up in stuff and I lost money. So important to kind of calibrate as much as you can for that. All right, let me take some questions. By the way, if you want a copy of the slides, tradersmastermind.com/open, that's a much easier URL, and they are instant download for you to review, because I know I've covered a lot of stuff very, very quickly there. Thank you for your questions. Okay, let me look and try and extend these. What have we got here? Is there a recording we can access after? Yes. Who's put that? Yes, Hassan. Yes, there is a recording, and it will be emailed to you as you're registered for this. You will automatically get an email. Okay. What's this? Late joining. Will there be a recording? Yes, there'll be a recording, Timothy. No problem. That will be sent to you. Which open on the DAX GMT Andre has put? Which open on the DAX GMT? So yeah, GMT at the moment, UK time at the moment, DAX is 8 a.m. open. That's when the cash bell, ding ding, off we go. And the FTSE as well, actually. Let's see what we've got here. Mr. Hippolito, you trade the open without a key level, or you're just trading momentum? I think you know this answer. I like to use a target as a magnet. So I'm really reverse engineering things quite a lot and using these, deploying these and saying, okay, hey, that's the level I'm looking for it to potentially go to. How can I jump on board that? And is momentum going to take me there? If the question is without is the key level that we're bouncing off, then if there is a key level there to work off, even better. You know, it's an extra green tick. You know, if it's kind of pulling back and holding at price high, for example, then that's not bad, huh? Is positive? Another one here from Selvan. Thank you, Selvan, for your question. Is positive negative averaging dangerous? Listen, anything can be dangerous, right? If your discipline is not dialed in, if you have a propensity to hold trades too long, then it is all dangerous. I would never ever recommend averaging into a loser. There are some circumstances potentially, if you're an advanced trader, potentially, but honestly, I think the easiest thing to do is say just never ever ever add to a loser. I think it's the easiest rule of thumb, because you end up being in your biggest trades when you're losing and your smallest trades when you're winning. Now, adding to winners is is absolutely to be encouraged. That's a tricky skill to develop, and I think that's you know, like a more intermediate advanced skill set, but definitely should be looking at points of where you could add to the trade to maximize the value of the winners. Because if you're in a trade like, you know, those examples there, if you catch that low and it finds support and it starts to rally and you buy that, you know, you really should be looking to pile more size on as it pushes through the highs. This is maybe, you know, different to scalping the open here. If you're just scalping the open, fine, you probably don't want to be playing that game. You want to be looking to peel some off straight away. But if you're looking to let that trade mature into something bigger, then you absolutely want to be finding ways to add more size onto the trade whilst capping off the risk. Now, there's downsides to that. This is a whole other topic, but that's something that to definitely look for. I think adding to losers, I could sit here and say, yes, under certain conditions, you maybe do this, and you can maybe splinter out your trade into a couple of tranches and do this. And yes, there is an argument for that under certain conditions, and I don't disagree with that. But I think unless you have really good kind of traction with that methodology, I just wouldn't even be adding to losers. I think for 95% of people, adding to losers is a bad thing. Andre has put, doesn't 1 minute kill the trades because of spread? Not really. Well, no, I mean, listen, the spread is so tight on these main instruments like DAX, Dow, and, you know, the volatility is moving, you know, especially at the moment. I mean, 100 points at the open is nothing. It's just I'm a little bit quieter today, but, you know, still that call it order magnitude of move, 100, 200 point move when you're paying a 1 point spread or 1.5 point spread, 2 point spread, whatever you're paying, meaningless, right? But then I did mention be careful, because if you constantly scalp, you know, the spread can add up. And yes, if you trade the cash index, if you're day traders, I think that's a better way to trade that. Can I get all the class records? Yes, they'll be sent to you, pal. All the recordings are sent. This is an interesting question. I really like and good trading fake outs and whole numbers, but I feel like I flip between strategies at the open and fade and follow with fake outs. You know what? This is a good question. Maybe I'm going to paraphrase it a little bit and simplify it a touch. Getting flipping between strategies is the nemesis of trading the open. That's what will kill the open. You know, why I kind of outline ideas for the open is I come up with an idea, and yes, I may have a little bit of flexibility, but it's far better if you have one idea, you calibrate yourself to the open, you say, right, I think it's going to do this, and then you wait for that only in the trigger for that. And if it doesn't happen, you move on. That's a far better structured way of doing it and learning than it is to go, I'm long, I'm short, because that just catches you out, causes you to trade on tilt, causes frustration, causes all discipline problems. And you might think, yeah, I'm going to miss stuff in this, but you're trying to improve your kind of skill set, your opening skills, right? And so if you come up with a couple of ideas, one or two maybe, and then you see if the market is confirming that idea and that idea generation process that you've got from calibrating yourself to the prior conditions, then you're in a nice position, right? You're in a nice position, and you can either be right or wrong. And if you're wrong, okay, maybe you lose. If you take the trade, you're losing. But if you're wrong, as in the conditions are just different, you're not getting chopped up. You can wait. That's a good question. Yes, recording. Yes, recording. Yes, to recording. How do you set that trend flip up, down, MT5? Not sure. Not a big user of MT5. Do you pay attention to the volume at the open by the indices? That's a really good question. I kind of do. If I'm honest, less so now, because the volatility is so much larger. We're going to get volume at the open, and very often we get, when the pullbacks, the volume is slightly lower. If you're used to looking at volume, keep doing it. If you're not, don't add it for the sake of it. There's better things to add to help your decision making than volume. Personally, I think at the moment anyway, in the current conditions, there's a time and a place for volume, and that's something maybe in the kind of middle of the day, we're looking for that volume spike and the crescendo and all this type of stuff. But range is, I think, far more effective metric to judge the move by than volume. Do you give much weight to yesterday's high-low for direction? Yes, absolutely. You know, where we are in position relative to yesterday's high or low. If we're gapping out of range, the two types of gap, right? Gap up, well, four, I guess. Gap up, gap down, but it's still in yesterday's range, or range gap, so it's gapping out of the prior day's range to the high side, or gapping out of the prior day's range to the low side. And the stronger the market, the bigger the gap. So absolutely, I do. I'll take a last couple of questions here, guys. What's this question? I've read about your call and try to trade the money, of course, with leverage and lost money. Is there a problem of risk, or am I take not too much time to watch the market data news? If you're losing money, this was Stefanos. Might butcher your name, apologies. Scale it back, go back to demo. Take the focus off the P&L, focus on the structure, slow things down, develop 1 or 2 strategies, look at where the triggers are occurring, and be much more clinical about when you're executing. It's too easy to fall into the trap of, hey, I'm going to chase that, I want to get money back, I want to get the money back. You forget about P&L, dial things down, very, very small amount, maybe on a demo, and try and get more clarity and structure to your trade would be a good thing without digging in massively into kind of what you're trading. This is a good question from Robert. Should your position sizes for scalping the open be a fixed amount in your opinion? I think so. I think you should have that ready beforehand, so you're not mucking about trying to dial in position size. You go, right, this amount of contracts I'm doing, it's calibrated to the expected velocity and volatility of the market. Fine, that's how much I'm expected to lose, give or take, and then you have the order of magnitude, right? Then you're not kind of trying to calculate, oh, it's got to be this, it's got to be that. Give or take what you're going to do. Now, when you get more experience, you might be able to have 3 tiers of size and go, hey, if my stop's this size, I can do that size. If my stop's going to be this order of magnitude, and make a quick on the fly decision about how much risk to allocate. But the fewer decisions you can make on the fly, the better. And so far better to under-egg the size and make the trade and not make as much as you thought than if you got stopped out, you don't lose as much as you thought. That's far better. So err on the side of caution with a fixed size. Do you need to size up for scalping? Tools, good question. That is a good question. Do you need to size up for, if you feel like you've got edge and you feel like you are doing well, then yes, that is a time to put the throttle down, to be more aggressive, and to say, hey, my risk is less per trade, and if I'm being still very precise about when I'm entering, then I can dial some size up. But again, it is part of that thing of, okay, are you just scalping, or are you using scalping as a leg into a bigger trade? How are you positioning? But you possibly could do, because your risk per trade is less generally because you're using such much tighter stops. And so you can get into a position where you can pull a 10-hour trade out the back, and if you've got decent size with that, you're in a nice position. Do you need to use the 1 minute, or can you trade the 5 minute? Any preference? I think 5 minutes is too. It's good to calibrate yourself to the overall picture, the bigger picture, or reasonable big picture. Like I said, before the open, should I say? You're looking at the bigger picture. When you're trading, it's too high a time frame. If you're scalping, 5 minutes is too much. I think you've got to go down to 1 minute at least. Maybe you could do a 2, but we're scalping here. And listen, there's the absolute credibility to say, hey, I want to hold this trade longer. And that's what you should try to progress to, a trader that has a scalper's entry with a day trader's exit, because that's when you get the many R multiples. If you're focusing just on scalping, you want to kind of be right down on the lower time frames. Going right in the thing. I can't. I'll do a couple more questions, guys. I'll try and get all of them. I will try and get all of them, because I do value your time. I appreciate you coming and asking these questions. I can't hold trade for long immediately. I break even, the market will move my way. Have been going through for the long, sir. I'm not sure about that. Apologies. Can't hold the trade for long immediately. I break even the market. Yeah, if you're saying you move the stop to break even too soon, just don't move it. Just keep your stop in place. Have your stop in. Have your target. Leave the trade. Do that for 30 trades. See how you get on. Don't meddle with. Don't add any other variable that could go wrong. Just have your entry, your exit, your stop, your target. Don't touch the thing, because you moved the stop to break even because you fear giving back the unrealized P&L. So don't fear it. Accept the risk. Take the trade, and see what the outcome is going to be. How do you preset the instrument you will trade? Victor, how do you preset the instrument you will trade out of all the available ones? You have limited time. You should take your time. Just say, hey, and you have a preference the market you're going to trade, right? You say, hey, I like to trade the DAX, or I like to trade the Dow, or you like to trade the NASDAQ. You should probably have your go-to things. I really like trading the Dow, just my preferred instrument. And so that will always be my go-to. Now, listen, if there's a stock that's in play and I want to trade that, that's different. But I'm only going to choose, that's going to be if there's some really good pattern on daily I want to get involved in, maybe an earnings play or whatever. If I'm trading the indices, then I'm just going to focus on one. And it almost doesn't matter to a certain extent, right? If you're trading the S&P 500, you're trading the NASDAQ, trading the Dow, they're going to move in a similar manner. Yeah, recently we've had occasions where I felt like I've been in the wrong instrument. And you're like, God damn it, you're long and that thing's going, that thing's not. But you've got to pick one, right? Is VWAP available on MT4? Pretty sure it is. Pretty sure it is. Where can I confirm the trend of the market? Don't overthink it, pal. Just don't overthink it. Look at it. Look at it with your eyes. You're not writing an algorithm. If I put 5 charts in front of you and said to you, hey, what's the trend? You could tell me. Don't overthink it. Look at it and say, is that a decent uptrend? Yes. It's choppy. Just trust your judgment on that. I could tell you linear regression. I could tell you moving average, distance from moving average. I could give you all these kind of indicators, but nothing. You're a discretionary trader, right? We've got our eyeballs and our gut and our instinct. Use it, and that's something you can trust and say, hey, I think it's a trend. Yeah, it's a trend. It's not a hard thing to decipher, but just trust and confidence in your judgment call. Make the decision. It's a trend. Bang. Stand by the decision. You got your stop if you're wrong, but stand by your decision. How do I get recordings coming? Recordings coming. I'm trading okay, but giving too much back. Dial it down, dial it down, dial it down, dial it down. Size, low, low, low. Go back to basics. Get your plan sorted out. Get your strategy, 1 or 2 strategies. You know, that's fixable. Yeah, and maybe analyze what you're giving back. Why are you giving stuff back? Are you over trading? Are you doing this? Are you doing that? That's an effective way of not getting caught and giving too much back. Do I think England will win the World Cup? Of course, Johnny Costa. Of course, England's going to win the World Cup. Performance is pretty good. Can't argue. Can't argue the performance. I think it was pretty good. I think we've got a good chance as any. Right. Thank you, ladies and gents. I think I've got to everybody. Apologies if I've skimmed past one. I had quite a few questions, but I appreciate your time. Thank you very much. I hope you enjoyed this one. I'll see you next time. Get your risk managed. Take care. Bye-bye. See you guys.